If you're staring at the stock ticker right now, you're watching something analysts once called unthinkable. The foundation of the North American financial system isn't just shaking, it's under pressure in real time. Billions of dollars are hanging in the balance, and markets are reacting fast. If you have money in an American bank, if you hold stocks, if your mortgage, retirement account, or business depends on stable capital flows, you need to pay close attention. Because what started as a tariff fight over aluminum, lumber, and energy may be morphing into something much bigger, a financial confrontation. Sources indicate that Ottawa may be exploring regulatory tools that go far beyond traditional tariff retaliation. Instead of responding only with counter tariffs, Canadian officials are reportedly examining financial leverage, the quiet plumbing of cross-border capital that most people never think about. And that's where things get serious. For years, trade disputes have focused on physical goods, trucks, trains, pipelines, shipping containers. But the real backbone of the US-Canada relationship isn't just steel and oil, it's capital. Banking channels, clearing privileges, corporate lending, daily transaction flows measured in the billions. If those channels tighten, even temporarily, the ripple effects could be massive. Reports suggest Canadian regulators have been reviewing the operational footprint of US Schedule II and Schedule III banks operating within Canadian borders. That may sound technical. Here's what it means in plain English. American financial institutions operating in Canada depend on regulatory permission to clear transactions, issue loans, and move capital across the border. If those permissions were ever restricted, even partially, Wall Street would feel it instantly. Investors understand this. That's why financial stocks tend to react sharply whenever cross-border regulatory risk increases. The American banking sector isn't isolated. It relies heavily on integrated North American supply chains. Corporate clients move funds back and forth every day. Auto manufacturers, energy firms, retail giants, all of them depend on seamless financial clearing. If that pipeline slows, treasurers scramble, liquidity tightens, markets panic. Now here's the strategic layer. Donald Trump has leaned heavily on tariffs as a pressure tactic. The theory, apply economic strain until the other side concedes. But critics argue that tariffs are a blunt instrument. They hit goods, they raise prices, they create friction. Mark Carney, by contrast, is not known for blunt instruments. He is a former central banker who understands systemic leverage. He ran the Bank of Canada. He ran the Bank of England. He understands capital flows, counterparty risk, and regulatory choke points. And that's why some analysts believe Ottawa may be thinking several moves ahead. The US financial system is enormous, but it's also interconnected. Canadian banks operate heavily inside the United States. American banks operate inside Canada. It's a tightly woven fabric. If one side pulls too hard, the fabric tears for both. This is why escalation becomes dangerous. If Washington retaliates by targeting Canadian banking assets in the United States, markets could interpret that as systemic risk. And systemic risk is the one thing investors fear most. Retirement funds, municipal bond markets, commercial real estate portfolios, liquidity markets. Everything is linked. That's why this isn't just a trade story. This is about trust. For decades, the US dollar and American financial institutions have been viewed as the safest harbor in global commerce. But when allies begin stress testing exposure, even quietly, global capital takes notice. Europe watches, Asia watches, sovereign wealth funds watch. When uncertainty rises, capital becomes cautious. Lending tightens. Risk premiums rise. Borrowing becomes more expensive. And that's where this could hit home for you. If banks feel geopolitical risk rising, they don't absorb it quietly. They price it in. Mortgage rates tick higher. Auto loans become stricter. Business credit lines shrink. Investment slows. That's how financial tension trickles down to Main Street. At the same time, tariffs already pressure supply chains. Add financial friction to that mix and costs compound. Lumber, energy, critical minerals, cross-border manufacturing. Every additional barrier increases price volatility. So what happens next? There are three realistic paths markets are watching. First, de-escalation. Markets drop sharply enough that political leaders step back. Tariffs soften. Regulatory threats cool. Financial channels remain intact. Second, escalation. Rhetoric intensifies. Regulatory tools expand. Retaliation follows. Markets swing violently. Credit markets tighten. Third, institutional intervention. Congress, central banks, or business leaders step in to stabilize expectations before volatility spirals. The key variable is ego versus economics. Markets are betting that economics wins, but uncertainty remains elevated. One thing is clear, the era of assuming trade disputes stay limited to goods may be over. Financial leverage is now openly discussed as a strategic tool that changes the chessboard. Whether this becomes a brief shock or a structural shift depends on decisions made in the next few days. So as you watch markets move, ask yourself this: is this temporary turbulence or the beginning of a larger realignment in North American economic power? This situation is fluid. Markets are volatile. Political rhetoric is escalating, and the financial relationship between the United States and Canada may be entering a new phase. Stay informed, watch capital flows, not just headlines. Because when finance becomes the battlefield, everyone with money in the system is involved, whether they realize it or not.